Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a bakery business idea. We continue talking about small businesses, small business ideas. And today, during previous video, we were modeling cash flow statement. And today we need to answer the first very important question, which every entrepreneur and every future business owner asks: how much money I need to start the business? And today we will be answering this very simple question. To answer this question, we need our cash flow statement be done. So we can't calculate the amount of financing needed without the cash flow statement. So the first exercise is to build the revenues, expenses, all the inflows, outflows, then put them inside the cash flow statement. And now today we will be answering this question. So as usually, like, share, subscribe our channel. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be placing all these tutorials. And when I'm completely finished with this financial model, I will give you all the links in the description of this video as well. So you may watch all the tutorials from scratch absolutely free, one by one. So first of all, let's briefly run through what we did during our previous tutorials. So we have the unique rule through the whole financial model. So all our inputs are colored with this blue color. So these are the inputs, these are the inputs, these are the inputs. So all other cells are formulas. So we are not touching them during scenario modeling, during playing with inputs. So we are working only with blue cells. So first of all, we are setting up the first year of our financial projections. Then we are setting up the product line. So what types of breads, of cakes we are going to sell. We can switch them on and off from calculations. Then we specify the sales plan monthly. Then we have global and local coefficients for the sales plan to increase and decrease the sales plan, so we can globally decrease the whole sales plan and decrease, and we can decrease and increase specific items inside the product line to make us see how this or that product affects the cash flow statement, simple and discounted payback period. So this is very interesting. Then we are setting up the selling price. We have global and local coefficients for the selling price. Then we have 5 types of customers. We can specify, give them the names. Then we allocate the revenues for these between these 5 types of customers. We can specify the average check for each type of customer. We can switch them on and off from calculations to see how the business performs with or without this or that type of customer, because maybe we are too optimistic with the revenues from coming from this or that type of customer. Then we have the list of ingredients which we use to produce these cakes and breads in our product line. So this is the list of ingredients. This is the price per unit of each ingredient. We can switch on and off different ingredients from calculations. So here we have global and local coefficients for ingredients costs, for the pricing of ingredients. These are the prices, and we can increase them and decrease them globally or locally for specific ingredient, and see what will happen with the cash flow, with payback period, with financing needed, and so on. So here we have the list of ingredients. Then here on this tab, from top to the bottom, we have the list of product, different types of breads, cakes, and so on. From left to the right, we have different ingredients which participate in cooking the product line And here we specify the consumption in natural units of this ingredient, how much units of this or that ingredient we need to cook one unit of product. So for example, for bread number 1, we need 5 units of ingredient number 1, and we need 8 units of ingredient number 15. And as a result, we get the direct cost per one bread type 1. And then these direct costs start traveling to the sales plan and then to the cash flow. So this is the list of ingredients. Then we are specifying how fast, by the way, here we specify when we start operating activity, when we get the first revenues. Then we have our 5 types of customers, and here we specify how fast we are reaching the target revenues, how fast we are reaching the target sales plan. So some customers may reach the target revenue faster, some of them will be they will need more time to get the target revenues, and we can specify these values in percentages here, and these values will affect the cash flow statement. And the result of that exercise will be, so we will be able to see, maybe we will need some additional financing to cover operating losses, and this will increase the total amount of money that we'll need to start the business. So this will be a very interesting exercise. I will show you it later. So then we specify, then we start working with fixed costs. So here we have the list of fixed costs. Here we have the typical year for fixed costs. Here we, inside this typical year, if we do have some seasonality in these costs, we can specify the seasonality here. We can increase and decrease globally and locally different fixed cost items. And also we can switch on and off different fixed cost items to see what will be the performance of the business with or without this or that expense. So this will be very interesting to look at the cash flow statement in that way. Then we start talking about payroll. Here we specify the name of position, the salary per person on each position, the amount of people on each position. Here we have global and local coefficients for salaries, and here we can switch on and off different positions from calculations and look at the cash flow statement. Then we are traveling to the investment plan. So here we can specify what we are investing in. Here we can see when we are investing. This is the moment when we start operating activity. And before this moment, we have 3 month long period of the investment stage. And before we get the revenues, we can specify what we are investing in inside the investment stage. We have global and local coefficients for investment plan costs. We can switch them on and off specifically to see how the business will perform in this or that way. Then we are adding a loan. So here we can specify the amount of loan, term of loan, interest rate, year, month when we get it, grace period for principal payments, grace period in months for interest payments. Here we can specify the rates for the taxes, and here we can see the cash flow statement. And now we are moving to our financing. So we need to answer how much money we need to start the business. So first of all, if we need to calculate the amount of financing needed, we need to look at the last line of the cash flow statement, cash balance at the end of the period. So the rule is very simple. This line must be positive or equals to 0. If this is negative, like it is now, this means that we don't have enough money. We need to put some additional financing inside the project. So what we are doing, so for example, let's put 0 for the loan. Let's imagine we have only our own pocket and we are financing everything from our money, using our money. So first of all, for example, we are looking at this line and putting this value with an opposite sign here. So for example, $63,000. So this means that in April we don't need any additional financing. So already put $63,000 and we do not have cash gap. So when it is red here, this is called cash gap. So we need to avoid any cash gap during the whole time horizon of our project. So then, for example, we will put here. So this will be the second month, for example. This will be the third month. So for example, we can go here, look at this period and find the biggest negative value inside this period and put it, for example, here. So this is the maximum. Oh no, the maximum is this one. So 48. And if we look further on the timeline, we are able to see that we don't have any cash gaps during the timeline. This means that we don't need to put any additional money from our side inside the project. And this means that the total financing needed for this business will equal to 2130110. So 2.1 million we need. And what is very important, so very frequent mistake is made by the majority of people who want to start the business. Usually a lot of models are being made with the step of calculation a year. So people are calculating yearly. So the step of calculation is year 1, year 2, year 3, year 4, year 5. Usually the best way to calculate your financial model is to use monthly, the step of calculation of 1 month. I will explain you why. Because when you are calculating yearly, you are not even able to see the real amount of financing. Because, for example, let's move here. If we look at 2023 here, we can see here the operating profit. And if we take a total of this line, we will see $110,000. And this means that if the profit is positive, if we would be calculating yearly, we wouldn't be able to see that we need an additional financing during the first 2 months of operating activity. And this is a very tricky thing, because if you're calculating using a year as a step of projections, you won't be able to see these operating losses, which will also form the initial amount of money that you will need to start your project. So when you're calculating yearly, for example, you're taking totals of this, see the plus of 110K, and you're happy because you don't need additional financing. But in reality, to start your business, you will need not also this amount of money during the investment stage, this. So you also need this amount of money and this amount of money until your project reaches the break-even point here in September 23. And this is a common mistake. So people usually, when they calculate using years, they don't see these losses. So they see this amount of money that they need to start the business, because it is placed in the investment plan, but they don't see this amount of money, these operating losses, but which are also form the financing needed to start the business. So be careful with that. You also always use monthly stepped calculations, because you will be able to see more accurately the right amount of potential operating losses, which will also be added to these investment stage expenses, and in total will form the amount of money that you will need to start your business idea. So for example, we can do it in a little bit another way. For example, first I would like to I will be investing, let's say I'm putting $2 million here. So this is the first portion of my financing. Then I'm eating this money here, then I will need some additional financing, let's say here. So let's say, so this will be the second portion of my money that I'm gonna put inside the project. And then the third part, I'm looking here at the biggest value, negative value. So I can do this. So I'm looking at the last line of the cash flow statement, and with an opposite sign putting these values. Then I can go to the end of the timeline, created totals for this line. So this is the amount of my own money that I need to start. And now, for example, let's add a loan. So for example, in April 23, so in 23 April, I'm gonna get $1 million loan. The long term will be 36 months. Principal payments I will have 12 months grace period. I will be paying interest right from the first month. So here we can see this loan, but we can see that we still have cash gap here. And what does this mean? So we are going again, looking at the last line of the cash flow statement. We can see that here we need $1,070,000 here. Then with an opposite side I'm picking this value. So maybe this will be a little bit more minus. I will add 1. Then 19. And the last portion of financing will be now we can go to the end of the timeline and see that we need in total of 2.1 million, 2149210 million dollars to start the business. We can create a very simple table here, call it financing needed. The first column will be type of financing. This will be amount. So this will be equity, loan, this will be total financing needed, so I will pull these values from the end of the timeline. Then I will add these two values to get the final amount of financing. So here we can see the total amount of financing, but there is a huge but in this case, because when we start building scenarios, when we start testing our business idea, building numerous amount of scenarios, it will take us a huge amount of time to paste these values, to calculate the total amount of money that we need. So we need to try to automate this process somehow. So what can we do in this case? So let's put here 0. So let's create a new table here. So what we will do, we will take the result from operating activity plus the result from investment activity, then plus loan minus interest payments minus principal payments, pressing enter. Then I'm extrapolating this formula to the right. Now I'm doing this formula cumulative, adding the previous value. Now I'm extrapolating. So what I need to do now, I just need to find the minimum value inside this timeline. And what I will do now, I will just go here, for example, press equals, and put this value with an opposite sign inside the cash flow statement, line equity. So this is the whole amount of money from our pocket that we're gonna put inside the project plus this loan. So now we can see that we have 0 here. Since this moment in October 2023, the project starts generating its own cash, and we don't need extra money to put it in, from our side. What is valuable? So we can change quickly the structure of financing. So for example, I want to so for example, I will take $1.5 million loan. So this is my money, this is the loan, and this is the mathematical 0 points after which the project starts generating its own cash. So here we can see the amount of total financing needed. This is our own money, this is loan. For example, we can create huge amount of scenarios. This value will change, this value will change, so we can very easily create new scenarios and the financing will be calculated very easily, very fast. This was the story about financing needed for the business idea. Like, share, guys, as usually. You can order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I finish completely this particular model, I will give you all the links in the description of this video as well. So you may watch all the tutorials one by one, from the first one till the last one with an overview of this model. So thank you guys for watching. See you next videos. Thank you and bye.